Welcome to the Mastermind Table podcast. And thank you for tuning in. Introducing your host, Ramir Heinze.
Hey everybody, welcome to the first episode of the Mastermind Table. Today we have a very special guest, and my name is Ramir Heinze. I'm your host with Berkshire Hathaway Parks and Wisebrook Realtors. I service the Louisville market as well as the Southern Indiana market. Today we have Richard Dickerson with Multiple Option Mortgage Services. He's a residential loan officer. His company actually has space within our office, so we are actually a few steps from around the corner from each other's office, as well as I've done a lot of business with him when it comes to first-time home buyers, all the way to investors and anybody in between. Richard, thank you so much for being on here. How are you doing today?
Doing great. Thanks for having me, Ramir. Happy to be here.
Absolutely, absolutely. So we'll just not wasting more time. We'll jump straight into it. So Richard, how long have you been a loan officer so far?
Great question. So I have been a LO for the last about 3.5 years. Started in 2020, and I've been loving every second of it.
Yeah. And why did you decide to choose a loan officer rather than maybe being a real estate agent or an attorney or any other industries that you could choose being within real estate?
Yeah, that's a good question. So my starting with loans is a little bit different than I think most other people's. I graduated college in the middle of COVID, and like a lot of people that graduated at that time, just didn't really know what to do. I was lucky enough to get in the front door at Mom's. My mother-in-law is, the owner of Mom's, and she said, hey, I think this would be something that could be interesting to you. Why don't you just come into the office, check it out, see what happens? And I was like, all right, cool. I was originally planning to go to grad school, and I ended up loving it. So after a couple of weeks of kind of learning the ropes, I decided to attempt to get my license, passed it on the first try, and everything else is history.
Okay. Well, cool, man. Well, I know a lot of times when talking to clients about real estate and about buying, the number one thing that comes up is interest rates. They're too high. I want to get back to 2021 where they were 3%, or even 2019 where they were 4%. Anything like just the interest rates are just too high right now, which they're at 7.5, 8 or so, somewhere around there.
Yeah, depending on loan size and credit score, which obviously impact those things, but we're going to be anywhere between about 6.75 on a good credit score government loan versus, about 7.5 on a lower credit score, maybe conventional or even a bank loan, something like that.
Sure. Yeah, and I know for some people they're willing to get past it and understand that, I may have a higher interest rate right now, but I know that when interest rates do eventually come down, which they will, it's just a matter of when, they understand that they could refinance out of it. And Richard is also a person that could help you refinance out of any loans that you're currently in, because of course the 7.5, 7% interest rate is not really ideal of what you're wanting to do. So Richard, kind of give the audience a little bit of a perspective of what a payment could look like from 2021 when interest rates were at that 2.5, 3% to what they are now, where you said that 6.7 to 7%. What is the difference?
Yeah, so I'll use about a $300,000 loan amount as my example. In 2021, and the way that I like to look at these differences, and that I think everybody really should, is just looking at the principal and interest portion of your payment, because taxes, insurance, mortgage insurance, those things do go into your mortgage payment, but they're static, right? So that's not affected by the interest rate or down payment. The only things affected by the interest rate and down payment are going to be, that principal and interest portion of your monthly payment. So back in 2021 with, like you said, those 2.5 to 3.5 interest rates, we were paying about $1,400, $1,475 on a $300,000 loan, which, to put that into comparison today, we're going to be looking at about $2,190 for that same $300,000 loan. So that's almost, $700, almost 50% more than you would have, which really makes sense if you think about it. 3.5 to 7%, that's doubling. The principal and interest portion is going to go up as well.
Oh wow! See, and that's why a lot of people are caught up in not wanting to move because they're stuck with that such a low rate because maybe they've bought more house, or it's just really that good of a financial deal. A lot of times I've heard the phrase of, because when they have a 3% interest rate, they were getting it at a premium price. They're almost borrowing money for free. And this is a very good example right here of somebody who's getting money almost for free versus having to pay $700 extra just from 4% difference and what the interest rate would be. And Richard, what are creative ways that you can kind of get around maybe some of those higher interest rates in today's market that you've been kind of pursuing or recommending to your clients?
Yeah, so it really just depends on that client's situation. So something that I've heard a lot of people talk about, a lot of my different investors, is those 3-2-1 buy downs, which can be a great product. 3-2-1 buy down, 2-1 buy down, 1-0 buy down, which essentially is just the amount of years that your payment is going to be a lower interest rate.
Okay.
While that's fantastic, especially for someone that thinks they're only going to be in the home for a few years, someone that may be in the military or has just moved for their job and knows that they're going to be hopefully relocating in the near future. Whereas if you find someone that has the home of their dreams, maybe we look at buying the interest rate down permanently. Mm-hmm. Where the real difference in those things is on the 3-2-1 buy down or those temporary rate buy downs, you're going to be paying the difference in interest just up front out of pocket, as opposed to on a permanent rate buy down, you're having that lower interest rate for the life of the loan. So it achieves a couple of different things. It lets you put more money towards principal right away, which helps if you go do refinance or go to sell the home in the future. You'll have more equity, things like that. So it really, to answer your question, just depends on the person's situation and their goals.
Sure. And can you give like an example of a 3-1 buy down? Like, so at this it would be at this interest rate and then go to this and then this. Like, what is something that you've seen when it comes to those kind of buy downs?
Yeah, so I'm actually quoting one right now. The person is they're at the par rate, so that's where they're not paying any extra money for the interest rate. They're going to do a 3-2-1 buy down. So for that first year, they're going to be 3% lower than their par rate. So as opposed to paying 7.25% on the interest rate, they're going to be at 4.25%. The second year, they're going to be at 5.25%. Third year, 6.25%. And then from the fourth year through the 30th year, so the rest of the loan, they're going to be at that 7.25%.
Okay. Well, that does sound really intriguing, especially anticipating that interest rates will be significantly lower than they are now in 3, 4, 5 years, things like that. And then the other thing that I know that we've had conversations with some of our clients when talking about ways to get around interest rates is a 5-1 ARM product. Could you speak a little bit further on that? Yeah,
so an ARM is something that kind of got a bad rap due to the housing crisis of 07, 08, 09. An ARM is an adjustable rate mortgage. And like Ramir was saying, a 5-1 ARM is the most common one that we see. So that is going to be fixed for 5 years. That's what the 5 is, the first number. And then the second number is going to be how often that rate can adjust. So a 5-1 ARM is fixed for 5 years and then can adjust every year after that.
Okay, excellent. And then I know, what is the cap? For example, what could the cap be on something of after that 5th year, then your mortgage, your interest rate would then at that point start going up? What would that cap be?
So again, that just depends on the ARM product. So there's really a third number when talking about ARM. So let's say it's a 512. So that third number, that 2, is going to be the cap that it can go up in a given year. So it's fixed for 5 years. Next year, and then after it's fixed, it can adjust every year a maximum of 2% that year. So let's say we start off at 5.75. We're fixed for 5 years. That 6th year, the market rate is really closer to about 8.5. Well, because we were locked in at that 5.75 and our ARM is a 512, we can only go up to 7.75, even though the market is really closer to 8.5%.
Okay. Okay,
And there will
awesome.
also be caps as well, which you will see on a loan estimate, and your loan officer should be talking to you about the caps, just so that you're not surprised when you do get to a higher interest rate after the adjustment period.
For sure, for sure. And for anybody listening, one of the major things that I really appreciate about moms and that you have to be careful with about some lenders is whenever they're factoring in your payment and then they're giving you what their options are, their different products, then you need to make sure that they're giving you all different levels of different products. You need to be able to talk about the buy downs, you need to talk about what the current rates are, these ARM products, just multiple if you want to go FHA, conventional, if you could go VA, there's tons of different products that are out there that you need to be made aware of. And so we've recently had a very good success story of where moms has actually been able to save a client $400 a month on a mortgage payment. Richard, could you care to elaborate on that?
Yeah, so that was a very fun one. Those are, my favorite types of loans where we can come in and say, hey, this is, looks like a great product, but let's see what we could really do. That product was a 1.0 temporary buy down. So for the first year they were looking at it, this was the other officer's product. We're going to be paying, that 1% lower, which was nice, but then for the life of the loan, they're going to be about 7.5. So for the same amount of money as the buy down, we were able to get them a lower permanent rate buy down than that 1% temporary buy down. So we were saving them $400 off the jump by lowering the interest rate more than 1% for the life of the loan. And now I was kind of shooting myself in the foot there because I know on a 1.0 buy down they're going to come back to me and refinance, but that's really not what we're looking to do or what's best for the client, right? You want them to be in a payment that they're happy and comfortable with for the life of the loan.
Yeah, for sure. And for that specific client's needs, it was definitely more of a peace of mind for them to be able to have that permanent buy down. Because with that permanent buy down, they're able to get the payment, they were able to get the house that they love, and we were actually looking for houses for a year and a half. So they're actually able to get the house that they loved in the area that they loved in a price range that they felt a lot more comfortable as, because when we originally found the house, the price was a little bit reaching. But because we were able to ask for closing costs back, we got a good amount of closing costs, we're able to buy down their loan and then be able to get that into that comfort range for sure. And Richard helped navigate through that because it was a very tough time and a very tough transaction to get through. But I really appreciate moms for helping us get through that kind of transaction. Another thing that I want to talk about is that you have to be careful with when speaking with lenders, and this is why I really love moms, is whenever they're quoting you your payment, they're going to give you your principal, your interest, your taxes, and your insurance. The taxes and insurance are going to be more of an estimate because you can't really 100% know those, but your principal and interest, they're able to pull it directly from the third-party lender because they are a mortgage broker. And so the taxes is the biggest thing that you have to be careful of. Is some lenders will quote your taxes off of what the current assessed tax bill is. But when a property sells for more than what it previously sold for, it's going to re-trigger a tax assessment and the taxes are going to go up. So mom is in your payment is going to tell you, here's what your taxes are going to be estimated, going forward. So we're going to raise your payment higher so that way you don't have to worry about your payment changing drastically or anything like that. And so moms has done that for a lot of my clients. That's why I always want to review the loan estimate with my clients to show that, because not all lenders do that.
Absolutely. I mean, it's completely legal as well. Legally we are able to use the current tax bill, but as a loan officer, I know as soon as, tax season comes, which in Kentucky is November, December, they're going to be doing an escrow check where the lender looks at it and says, okay, we only saved $2,000 for our tax bill, but it came out at $2,500. So you're either writing a check for that $500 difference, or you're going to add it to the next year's payment. Well, remember, your tax bill is $2,500 now, so your payment's already going up on top of that $500 divided over those 12 months. So you end up having about a $100 swing minimum on those sorts of things. And it can really get tricky on new construction, because with new construction, the tax bill is on just the land, right? You don't have any improvements, you don't have a home, anything like that. So the numbers can look very low and very attractive, especially when they're using that current tax bill without the assumed assessed value. And you can get the property tax rates from the internet. We have special websites where we can look up the actual, current bill, do some math, and figure out what that exact tax rate is. But if you're just looking for a general idea, you can go on to, any sort of state county clerk website and find the general tax rate.
Yeah, for sure. And like you said, I mean, that could drastically change your payment, especially if it's a new construction and your lender was quoting you at what the land cost is, and you're buying a $400,000 house. Your property taxes might just be going up $4,000, and that's something very important that you need to be made aware of to help budget for buying a house.
Absolutely.
And Richard, what are things that, when you're looking to borrow property, what documents are you needing to know if you're able to qualify?
Yeah, so there's really two types of borrowers, or to simplify things, two types of borrowers. We're going to have our self-employed versus our W-2 income borrowers. So let's start with W-2 because that's a little bit easier. For that, we're going to need the last 2 years W-2s. So as of right now, the 23 and 22, 2023 and 2022 W-2s, as well as the last 2 months bank statements and the last 30 days pay stubs. Now those are things that I can look at, get all of our information on, make sure that we have our income and assets correct, and then we're going to do a credit report. So we can do a soft pull at Mom's just to get an idea of what we're looking at, and if everything looks good, we can run that soft pull through the automated underwriting system, which allows us to give an absolute, yes or no when writing that pre-approval offer. Now, if you're self-employed, things are going to get a little bit more document intensive. So we're going to need the last 2 years tax returns, as well as if you get 1099s or a K-1. A K-1 is going to be if you're in an LLC or an S-Corp, something like that, versus just a sole proprietorship. It just depends on how you do your taxes, but we will need those taxes as well as those, minimum 2 months bank statements and 30-day pay stubs. Again, if you're paying yourself a salary versus just taking draws or commission, things like that.
Sure. And so what is the benefit of a soft pull rather than, a normal credit check?
Yeah, so a soft credit pull, what that does is it's only going to hit 2 of the 3 bureaus. Sometimes it'll hit all 3, just depends on which credit system your loan officer is using. But what that does is it doesn't pull any trigger leads. So something that a lot of our clients have been stressing about is these trigger leads. So you run a hard credit pull, and then all of a sudden they're getting calls from every single big lender you've heard of, the Chase, PNC, Rocket Mortgage. So those large companies are able to pay the credit bureaus for trigger leads. So anytime you go and apply for a mortgage, eventually we're going to have to do a hard credit pull. As soon as you do a hard credit pull, these large corporations, these large banks get a notification that, hey, this person's in the market, you should give them a call, see if you can essentially win the loan. With a soft credit pull, you're not getting those trigger leads until we actually are under contract, sending everything to underwriting, getting ready to truly move forward with the loan.
Okay, excellent. And to wrap things up, we're going to start asking these few questions, wrapping things up is kind of, if you could go back 10 years and knowing with you what you know now about being in real estate, owning property, all that kind of stuff, what would you tell yourself 10 years ago to prepare you to be where you're at now or to be even farther where you're at?
That is a great question. I would say start speaking in front of people sooner. That was something that I really struggled with when I first started the job. I think I've come a long way, but just being able to have those tough conversations where if someone doesn't qualify for the loan or there's some repair they need to do on the credit, I was always a little hesitant, to have those conversations. But the more you speak to people, the more you're in front of people, the better you get at that. It's just practice, right? Another thing is that when things are tough or when you have a little bit of anxiety, that's probably a good thing. It probably means that you don't know that subject as well as you should. So dive into that, figure out why you're having that anxiety, why you're having that little bit of a second thought, and try to correct it.
Excellent, excellent. Is there any books that you recommend that some of our listeners listen to learn more, or just learn more about real estate, or just in general about life?
Yeah, so a book, this isn't really exactly 100% real estate oriented, but I'm a big fan of Extreme Ownership by Jocko Willink. It's essentially just talks about how at the end of the day, you need to be the one who owns everything, right? If a deal falls through or if something goes wrong with the loan process, I can't blame the borrower. It's on me at the end of the day, right? Even if they didn't get me the documents in time that I needed, they didn't sign this in time. What could I have done to make sure that they did sign that in time or did get me the documents? It's no one's fault but my own at the end of the day.
I love that. I love that. Yeah. And for anybody who's listening who wants to talk to you about refinancing in the future or purchasing a property and talk about the financing aspect of it or anything like that, what's the best ways to contact you?
The best way is going to be my cell phone. You can give me a call or text anytime, and that's going to be 502-741-0922. I also check my email regularly, every day, every night, including the weekends. So if that's more your speed, feel free to email me at Richard, Richard, at momsoptions.com, momsoptions.com.
Excellent, excellent. And thank you all so much for tuning in. Make sure to follow me on Instagram at Ramir Heinze, RemirHeinze. And if you're interested in purchasing a property here in the Louisville, Kentucky market or Southern Indiana market, shoot me a DM and spell out home, HOME, and we'll make sure to connect and talk about your situation, talk about your plan to figure out what's best for you and your needs. Make sure you tune into the next episode where we will have another great guest, but I'm going to leave that up for you all to tune into the next episode to find out who that is. Thank you so much, Richard, for tuning into the podcast. Really appreciate you coming on and giving some insight about your world and about the mortgage industry and all that kind of stuff.
Yeah, thanks for having me. This was awesome. Hope to do it again.
Absolutely. Well, have a great day, you guys, and see y'all later.